Imagine that you know a potato farmer. He sells you the 1 kilogram of potato for $1. So one day, you found out that your local grocery store buys 1 kilogram of potato for $3. You thought about it for a while and found out that you can actually make very good profits by buying potato from the farmer at $1 per kilogram and then selling it to the grocery store at $2 per kilogram. You can basically double the money you have. But the problem here is that you don't actually have a lot of money to do this. But what if one day you met someone that will give you a loan for $20,000 and will not take any collateral from you, but on one condition? You have to repay him back in the same day, and he will also take a 10% fee on this loan. So you accepted and went to talk with the owner of the grocery store. He said okay, to save on the cost of the potato. So you took the money and bought 20,000 kilograms of potato for $20,000 from the farmer, and then sold them to the grocery store in the same day for $40,000. So you repaid the loan plus the fee, which will equal $21,800, and kept $18,200 as profit. Although the huge number of potatoes sold is a bit imaginary, the loan you took here is actually pretty similar to how flash loans work in crypto. Welcome to Cryptobie, where we explain cryptocurrencies and DeFi topics in the most simple and beginner-friendly way. In this video, you will know what exactly is a flash loan and why would you take one, how to take a flash loan, and finally, we will talk about the flash loan attacks. So, let's get started. So, what is a flash loan? A flash loan is a crypto loan, but without collateral needed. For example, you can borrow $1 million worth of crypto right now without providing any collateral, and you will get the money in seconds. But the thing here is that the loan needs to be repaid in 10 seconds or so. You may be wondering, how does the lender of this money make sure that the borrower won't take the money and run away with it? Well, that is because the borrower can't actually do that, as you take the money and repay it in the same transaction. So, how is that possible? Well, a transaction on Ethereum, for example, is different from a normal bank transaction. A normal bank transaction consists of one operation or step, like sending some money from your account to a friend's bank account. But on Ethereum, one transaction may have multiple operations or steps. For example, in one transaction, you can take a loan in DAI from Aave, buy Ethereum with these borrowed DAI tokens from SushiSwap, then sell this Ethereum for a higher price on Uniswap, and finally repay the loan plus the fee. All these 4 operations are done in one transaction. So, in flash loans, you borrow the money, make some profits with it, and repay it back, all in one transaction, and all the steps need to be completed successfully for the transaction to be confirmed. If, for example, you couldn't make profits, or even don't want to repay the loan during the allowed time period, then the entire transaction will be reverted back, as if it never existed. That basically means that if you didn't repay the loan, the money you borrowed will not be in your wallet, as if you have never taken the loan at the first place. All of this is done automatically, so there is no risk that the borrower will take the money and not pay it back. Now, you may be wondering, from where does this money come from? Well, currently, you can take a flash loan from Aave, and the money you will borrow comes from investors who deposited their money in Aave to earn some interest. When you take a flash loan from Aave, you need to pay a fee of 0.09% on the borrowed money, and a big portion of this fee goes to these investors. An important point here is that you also need to pay the gas fees like any other transaction on Ethereum. So now, you may be thinking, if the money needs to be repaid in 10 seconds, what is the point of these loans? Like, what can you do with them? Well, flash loans actually have 4 uses. The first one is arbitrage trading. Remember the story we went through at the beginning when you bought potato at a low price from the farmer, and then sold it to the grocery store at a higher price? What you did there is a form of arbitrage trading. You basically buy low and sell high. But with flash loans here, instead of buying and selling potato, you buy and sell cryptocurrencies. For example, you can buy Link tokens from Uniswap at $10 per token, and then sell them to SushiSwap at $11 per token, making a profit of $1 per token. But what if you want to make big profits? Well, you need to have a lot of money to buy and sell large amounts. With flash loans, you can take a loan from Aave for $500,000, buy with them 50,000 Link tokens from Uniswap, and then sell them to SushiSwap for $550,000. Then repay the flash loan plus a $450 fee, which is 0.09% of the loan amount that makes the total you need to repay $500,450. After repaying the flash loan, you can keep $49,550 in profit. All of this is done in one transaction and under 10 seconds. But the thing here is that now a lot of developers know about this, and there are a lot of bots doing this automatically, so your chance of making profits this way is fairly low, as the difference in prices between exchanges is corrected pretty fast. But still, some developers are actually making profits this way. So it is not impossible to do. The second use we have for flash loans is something called self-liquidation. So in DeFi, we actually have normal crypto loans, which are loans that require you to deposit a collateral. For example, you may be holding $20,000 worth of Ethereum, and you are bullish on Ethereum, and you think the price will go up in the coming months. But at the same time, you urgently need money to cover some emergency cost, but you don't want to sell your Ethereum. So to solve this, you can go to MakerDAO, which is a lending application, deposit the Ethereum as collateral, and take up to 50% of its value as a loan. In this example, if you deposit $20,000 worth of Ethereum, you can take a loan for 10,000 DAI tokens. But a very important point here is that if the price of your collateral, which is Ethereum, falls below a certain point, you will have to repay the loan or deposit more collateral, and if you can't do any of this, your loan will get liquidated. Which basically means that the Maker protocol will sell enough of your Ethereum, usually at a low price, to repay your loan, and you will be charged a liquidation fee of 13%. The remaining Ethereum after taking the fee will go back to you. To put that in perspective, in this example, this liquidation fee will be $1,300. So in a scenario like this, flash loans can help you avoid paying the liquidation fee. You can, for example, take a flash loan from Aave for 10,000 DAI tokens, repay the Maker protocol loan with these borrowed DAI tokens, and claim your deposited Ethereum. Now, you need to repay the flash loan plus the fee. To do this, you need to sell enough of your Ethereum, so in total, you will have to sell $10,009 worth of Ethereum to be able to pay back the flash loan plus the fee, which will equal $9 in this example. Finally, you repay the Aave flash loan, and just like that, you avoided paying the 13% liquidation fee and just paid a 0.09% fee, and all of this will be done in seconds and in one transaction. The third use for flash loans is collateral swap. Just like the previous example, you may have deposited your Ethereum as a collateral on Maker and taken a loan. But the problem is that after a while, you think the price of Ethereum will fall in the coming months. And you are afraid that your loan will get liquidated, and also, you may want to sell your Ethereum and hold another token. So to do this and avoid the liquidation, you may want to swap your Ethereum collateral for some Link tokens, as you think Link will go up in the coming months. But how can you do this with your Ethereum already locked as collateral on Maker, and to access it, you need to repay the loan, and you don't have the money to repay it now? Well, you can fix this problem with a flash loan. Let's say that the loan you took was for 10,000 DAI tokens. You can go and take a flash loan from Aave for 10,000 DAI tokens and then repay the Maker loan with these borrowed DAI tokens. After repaying the Maker loan, you can access your Ethereum coins, so you go and swap them for Link tokens on Uniswap. Now, you avoided liquidation and successfully swapped your Ethereum for Link tokens, but you still have to repay the flash loan. So to do this, you need to take the Link tokens, deposit them as a collateral in Maker, and take a new loan for 10,009 DAI tokens, which should be enough to repay the flash loan and the $9 fee. Now, you only have your new Maker loan, just like the beginning, but with Link as collateral instead of Ethereum. The last use of flash loans is something called refinancing, or more simply, interest rate swaps. So what if you have taken a loan from Maker and you pay an interest rate of 5% per year? After a while, your friend told you he took a very similar loan from Compound, which is another lending application, but with a 2% interest rate. Of course, that would make you regret taking that loan from Maker. But in this situation, a flash loan could actually allow you to switch your loan to Compound with a lower interest rate, even if you don't have the money to repay the Maker loan. For example, let's say that you had deposited Ethereum as a collateral in Maker and took a loan from 10,000 DAI tokens. To switch the loan to Compound, you need to take a flash loan from Aave for 10,000 DAI tokens, repay the Maker loan with these borrowed DAI tokens. Then, take the Ethereum you have and put it as collateral on Compound. Then, take a new loan from Compound for 10,009 DAI tokens and use these DAI tokens to repay the flash loan with the $9 fee. Now, you only have your new loan from Compound with the much lower interest rate, and you only paid 0.09% fee. So, like what you have seen, most of the uses of flash loans currently are related to DeFi loans. But an important point here is, how can you actually do any of this stuff? Well, for the arbitrage, you need to be a developer and able to write Solidity smart contracts to be able to make profits. As for the loans-related uses like the self-liquidation, collateral swap, and the refinancing, there are some applications that make these transactions very easy, like Furu Combo, Collateral Swap, and DeFi Saver. The best part is you don't need any technical skills to use these applications, and we will leave links to them in the description box below. An important point before we end the video is flash loan attacks. Flash loan attacks are a little complicated and can be done in many ways, but basically, it's when an attacker uses the borrowed tokens to exploit a bug or a vulnerability in the smart contract of a protocol or an application, like what happened with Beanstalk, which is a stablecoin protocol that was attacked recently in April this year. With Beanstalk, for example, the attacker borrowed around $1 billion worth of stablecoins, and then he staked the borrowed coins to get a lot of the Beanstalk governance token stock. Holders of this token have the right to vote on any proposals to the protocol, and when a proposal gets a majority vote, it gets accepted and executed. When the attacker got a lot of this governance token, that gave him a very high voting power, which means that he can vote on any proposal, and it will get accepted by the protocol. So he made a proposal to transfer all the money from the protocol to his own wallet, and disguised it as a proposal to donate money for Ukraine. Then he voted with all of his tokens, and the proposal was accepted. And just like that, $76 million worth of crypto were transferred to his wallet. Then he unstaked the stablecoins he borrowed, repaid the flash loan, and kept the $76 million he got. Other than this attack, many other flash loan attacks happened over the past few years, like the Cream Finance attack in October 2021, where $130 million were stolen. Also, we have the Pancake Bunny attack in May 2021, where the attacks stole $4 to $5 million in crypto. So, just like anything else, flash loans can have some good use cases and some bad use cases. Although the good use cases are still niche for most crypto users. At the end of this video, we hope you learned what you need to know about flash loans, and if you liked our video, hit the like button, let us know in the comments if you have any questions, and subscribe to our channel and turn on the notifications so you don't miss our new videos. Thanks for watching.